After studying this module, you shall be able to understand why financial sector reforms were initiated, know the status of financial sector on the eve of reforms, understand the broad philosophy of financial sector reforms, understand the differences between the first and second generation of reforms, describe policy reforms in the financial sector, and understand the issues relating to financial sector reforms. Financial system needs to mobilize and allocate resources efficiently in order to positively influence the performance of the real sector of the economy. A sound financial sector is a prerequisite for capital account convertibility as well. Soundness of a financial system has been elevated to a status where it is considered to be one of the most important fundamentals for judging the health of an economic system. Financial sector reforms are regarded as basic policy reform in developing countries. Financial sector need to transfer resources from saving surplus agents to savings deficit agents by overcoming information asymmetries in the market. If financial system cannot do the job assigned to it, the need for reforms in the financial sector becomes an imperative.
In the next section, we will dwell on the status of financial sector on the eve of reforms, which will enlighten the readers why financial sector in India needed to be improved. Let us now discuss the status of financial sector reforms on the eve of reforms. The status of affairs in financial sector reforms on the eve of reforms is caused by a policy regime in which monetary policy continued to be compliant to the fiscal policy. Instruments of monetary policy were deployed to provide of fiscal accommodation via ad hoc treasury bills at below market interest rate through the main part of the 1980s. As a result, the state of financial sector in India emerged as an apt example of financial repressions until the beginning of the 1990s.
Now we will try to describe the scenario in the financial sector in the pre-reforms era under three components: banking and insurance, debt market, and foreign exchange market. The banking sector was characterized by administered interest rates, large preemption of resources by the authorities, and extensive micro-regulations, which directed the major portion of the flow of funds to and from financial intermediaries. The lack of commercial considerations in credit planning and weak recovery culture resulted in large-scale accumulation of non-performing loans for public sector banks. Their capital base was eroded due to the accumulation of non-performing assets. The presence of entry barriers into banking and insignificant presence of private sector banks limited the scope for competition among existing banks. The end result was low levels of competition, efficiency, and productivity in the financial sector on the one hand, and severe credit constraints for the productive entities in the private sector on the other. They faced no threat to their existence and operated inefficiently while the insurance needs of the economy became varied over time. In the securities market, new equity issues were governed by a host of complicated regulations and detailed restrictions. Government securities constituted the predominant component of fixed income securities. The secondary market trading of such securities lacked depth. It was also a captive one, where the players were mainly financial intermediaries who had to invest in government securities to fulfill high statutory reserve requirements. The interest rate on government debt was administered, and the rate of interest charged by the Reserve Bank of India for financing government deficit was concessional.
There was barely any secondary market for the government securities, and such transactions were highly opaque and functional through over the telephone deals. The provision of fiscal accommodation via ad hoc treasury bills led to high levels of monetization of fiscal deficit through the main part of 1980s. There was little complexity in the foreign exchange markets, as well as maximum such transactions were governed by the inflexible and low limits, and also the prior approval requirements, leading to the limited external capital flows. It needs to be mentioned that the above closed economy setup kept debt markets underdeveloped and devoid of operation of any competitive forces.
The Indian exchange market had been heavily controlled since the 1950s, along with increasing trade controls designed to foster import substitution. Consequently, both the current and capital accounts were closed, and foreign exchange was made available by the RBI through a complex licensing system.
Let us now discuss the broad philosophy of financial sector reforms. The beginning of financial reforms in the country through the early 1990s was to be considered extent subject to the analysis and suggestions of several committees and working groups set up to address the specific issues. The procedure has been characterized by gradualism, consisting in implementation of measures undertaken after broad consultations with experts and market contestants. While resolving to achieve standards of international best practices, the policy makers kept in mind the need to fine tune the process, keeping in mind the underlying institutional and operational considerations. Reform measures brought about across sectors as well as within each sector were scheduled in a mutually reinforcing fashion. Attempts were made simultaneously in three directions. Firstly, effort was afoot to strengthen the institutional framework. Secondly, attempt was aimed at enhancing the scope for commercial decision making and market forces in a scenario which was emerging as more competitive. Lastly, attempts were also made to offer operational flexibility and inducements so that the preferred ends are attended via wide interplay of market forces rather than using the administrative fiat or coercion. In India, reforms followed a consensus driven form of sequenced liberalization through the sectors according to the Ahluwalia 2002. That is why, despite several changes in the government, there has not been any reversal of direction in the financial reform process over the last 15 years.
The major aim in the early phase of reforms, known as first generation of reforms, was to create an efficient, productive, and profitable financial service industry operating within the environment of operating flexibility and functional autonomy. The focus of the second phase of financial sector reforms, starting from the second half of the 1990s, has been the strengthening of the financial system and the introduction of structural improvements. The episode of Indian financial reforms will be constituted into six components. They include banking reforms, reforms in insurance sector, debt markets reforms, reforms in equity market, foreign exchange market reforms in other segments of the financial sector. The regulatory and supervisory norms were initiated in commercial banks owing to the gradual exposing of the banking industry to forces of competition. Norms related to prudential regulation, income recognition, and asset classification were implemented. Measures were put in place to build up risk management capabilities of banking and to ensure flexibility, operational autonomy, and competition in the banking sector.
The supervisory system has been revamped, keeping in view the key role of effective supervision in the creation of an efficient and stable banking system. Banking reform in India has not involved large scale privatization of such banks. The approach instead first involved recapitalization of banks from government resources to pull them up to appropriate capitalization standards. In the second phase, increase in capitalization has been done through diversification of ownership to private investors up to a limit of 49%, thereby keeping majority ownership and control with the government. With such broad based ownership, most of these banks have been publicly listed. This was designed to introduce greater market discipline in bank management and greater transparency through enhanced disclosure norms, improving the corporate governance in banks.
Measures were adopted to improve the institutional parameters, including the legal framework and technological system within which the financial institutions and markets operate. New private sector banks were introduced, and the number of foreign bank branches were expanded, therefore, unleashed forces of competition, which was intended to force public sector banks to align their conduct with market preference in a bid to improve their performance. The insurance business remained within the confines of public ownership until the late 1990s. Subsequent to the passage of the Insurance Regulation and Development Act in 1999, several changes were initiated, including allowing newer players, joint ventures to undertake insurance business on risk sharing commission basis. The Insurance Regulatory and Development Agency, IRDA, has been established to regulate and supervise the insurance sector. With fundamental reforms in government debt market in place, a functioning GSEC debt market was really initiated in the 1990s. There occurred a movement of the system from a strategy of preemption of resources through SLR from banks at administered interest rates and through monetization to a more market oriented system. Automatic monetization of the government's deficit has been phased out, and the market borrowings of the central government are presently undertaken through a system of auctions at market related rates. This single step loosened the dominant influence fiscal policy so far exerted on the monetary policy. An important step towards the objective of liberalizing, regulating, and developing capital market has been the setting up of the Securities and Exchange Board of India, SEBI, as the regulator for equity markets. Another significant development under the reform process has been the opening up of mutual funds to the private sector in 1992, which eroded the monopoly of UTI or Unit Trust of India, a public sector entity. With the opening of foreign institutional investors FIIs in 1992, the capital market was liberalized. The Indian corporate sector has been permitted to tap international capital markets, and similarly, overseas corporate bodies and non resident Indians, NRIs, have been allowed to invest in Indian companies.
With a view to improve market efficiency, increasing transparency, integration of national markets, and prevention of unfair practices regarding trading, a series of reforms comprising measures to liberalize, regulate, and develop capital market was put in place. Since 1992, reforms measures in the equity market have stressed on regulatory effectiveness, enhancing the competitive conditions, reducing the information asymmetries, developing the modern technological infrastructure, mitigating transactional cost, and controlling of speculation in the securities market. The Indian corporate sector has been permitted to tap the international capital markets by the means of American Depository Receipts known as ADRs, Global Depository Receipts known as GDRs, foreign currency convertible bonds known as FCCBs, and external commercial borrowings known as ECBs. Similarly, overseas corporate bodies and non-resident Indians have been allowed to invest in Indian companies. FIIs have been permitted in all types of securities, including government securities, and they enjoy full capital convertibility. Mutual funds have been allowed to open offshore funds to invest in the equities abroad.
The movement towards a market based exchange rate regime in 1993 and the subsequent adoption of current account convertibility with prudential safeguards were the significant measures in reforming the Indian foreign exchange market. Banks have been granted a considerable autonomy to undertake foreign exchange operations. A large number of products have been introduced, and the entry of newer players has been allowed in the market with a view to increase the depth of the market. Many
The Indian approach to opening the external sector and developing the foreign exchange market in a phased manner from current account convertibility to the ongoing process of capital account opening is perhaps the most striking success relative to other emerging market economies. There have been no accidents in this process, and the exchange rate has been marked determined and flexible, and the process has been carefully calibrated. The capital account is effectively convertible for the non-residents but has still some way to go for the residents.
reforms aimed at establishing prudential regulation and supervision and also enhancing competition and efficiency were implemented in other segments of the financial sector, especially non banking financial companies. Non banking financial companies, especially those involved in public deposit taking activities, have been brought under the regulation of RBI. Development finance institutions, specialized term lending institutions, non banking financial companies, urban cooperative banks, and primary dealers have all been brought under the supervision of the Board for Financial Supervision. Even after more than one decade of financial sector reforms, sustained predominant public sector entities in the sector has often been a topic of debate. India's approach towards treatment of insolvent public sector banks is an interesting issue. Rather than closing them down, policymakers in India have shown a preference to merge such banks with healthy public sector banks. It has been felt in certain circles that such an approach may give rise to a moral hazard problem.
In the late 1990s, India proposed legislative change to enable reduction in the government ownership up to 33% in the public sector banks. It was proposed that despite such ownership pattern change, these banks would manage to retain their public sector character. The proposal, however, failed to meet parliamentary approval in indicating a lack of political acceptability on privatization so far. In view of such problems, Rajan Committee in 2008 has suggested privatization of small public banks. There are suggestions in the literature in favor of outright privatized public sector banks, but it was countered on the plea that, in view no convincing reasons behind better corporate governance in the private banks, such as arguments does not stand to critical scrutiny. In fact, in appropriate state of affairs relating to corporate governance was commented on two ex-governors of RBI. It also needs to be mentioned in this context that the episodes of run on private banks, including prominent ones like ICICI, which took place, have taken place in the deregulated era.
Large private banks were nationalized with the mandate of inclusive banking. Nationalization of banks led to a massive branch expansion in unbanked rural areas on the one hand and a massive build-up in NPAs. The crux of the problem was how to reinvent public sector banking so that it can conduct meaningful inclusive banking and serve its original mandate. Reinventing public sector banks is a critical issue. So far, reforms in Indian financial sector are concerned. It may be argued that lack of inclusive banking has led to the creation of shadow banking in India. Only 35% of adults have bank accounts, and less than a third of household savings goes into the formal financial system, with gold and local money men being popular alternatives.
The central bank hopes to encourage a new generation of simple banks focused on deposits and payments. Mobile phone banking could help. Vodafone, a big global operator, has launched an Indian vision of M-Pesa, a service it honed in Kenya. Until initiatives like these take hold, there will be more episodes like Sahara. It is interesting to note that banking crisis in pre-independent India has been replaced by the episodes of crisis relating to non-banking financial institutions. Another related issue is the current role of foreign banks, whether they deserve the bigger role and what is the appropriately regulatory role for them. A recent study have established that foreign banks have been carrying on exclusive banking based on the metro based banking system on few branches, and their contribution to the pure banking activity in the form of financial intermediation has not been anything very significant. The study has also shown that foreign banks' exposure to the risky off balance sheet activity is extreme and goes up to 2800 times its own assets. The profit of the foreign banks is also much higher on account of risky conduct leading to risky banking markets. Another interesting point raised in the study relates to the footloose nature of the foreign banks despite the relaxations given them through the provision of WTO.
A very weak component in our financial system relates to cooperative banks. They are heavily dependent on refinancing facilities from the government. Competition from commercial banks, undue protection from the government, interference by politicians, dependence on capital from government as opposed to capital provided by members, poor quality of loan assets, lack of active participation from members constitute serious problems for these entities. To cap it all, existence of multiple regulatory authorities are impediments to effective regulation and monitoring of cooperative banks. In the 1980s, the role of retail investors in capital formation was a popular topic of discussion. The idea was to remove the intermediation from banks and let the capital flow directly. But when the domestic market opened up to foreign capital in 1993, the economic logic of getting domestic retail investors into the stock market to supply capital started to get weaker with every passing day. Also, whoever voluntarily chooses to enter the stock market gets a fair deal from companies and market intermediaries. Both SEBI and stock exchanges fail miserably on that count now. Indeed, poor grievance redress system and market manipulation happen to be the final argument to not encourage savers to invest in stocks. That will take place only in a scenario which includes an appropriate regulatory framework in place and an improvement in corporate governance in companies competing for public equity participation. Let us now summarize what we have learned in this module. The financial sector need to transfer resources from savings surplus agents to savings deficit agents by overcoming information asymmetries in the market. If financial systems cannot efficiently perform the job, there is a case for reforming the financial sector. Financial sector on the eve of reforms was very rigidly regulated in the pre-reforms era, hampering resource allocation in the market. The major aim in first generation of reforms was to create an efficient, productive and profitable finance service industry operating within the environment of operating flexibility and functional autonomy. The focus of the second phase of financial sector reforms has been the strengthening of the financial system and the introduction of structural improvements. Fundamental reforms have taken place in different subsectors within the financial sector. They include banking, insurance, debt market, capital market, foreign exchange market, non banking financial sector, etc. A number of issues remain pending so far as reforms in the financial sector are concerned.